Is this the time to be paying up for protection against downside risks in U.S. stocks, though?
That would, in our view, be slightly premature. We are thinking of late cycle risks and how to position portfolios for a changing environment, for a U.S. growth story that is no longer so positive. But right now, are we pulling all of our risk off the table or going underweight stocks versus bonds? That's not yet the case. Reasons why: we have several things like the leading economic indicator in the U.S., the unemployment numbers that are coming out, still showing that the U.S. is in good stead. There's a lot of growth still coming. We're seeing capex, investment intentions quite strong. So all of those signals are certainly late cycle, but not end of the cycle yet. Somewhere into 2019, towards the end of it, when the U.S. Federal Reserve raises interest rates to levels that companies perhaps can't handle anymore, is when we'd start thinking of recession risks being high and more probable than not. And
interest rates that might be difficult for companies in U.S. equities then, is that a 10-year Treasury yield at 3.5%, at 4%?
It certainly is nearer to that level of 3.5%. I'd actually look more on the shorter end of the curve to think about what companies can or cannot handle, and that for us is around 3.5%. So that, doing the math in terms of how many interest rate hikes are expected, we get to end of 2019 where we're at that pinch point for companies where leverage might be too high, where debt service ratios are not going to be favorable for companies to be able to handle.
But from here, do we just see a sort of slow grind higher until that point, or could we still see some sharp moves higher?
I think we could see some sharp moves higher. I mean, looking historically, if you take the last 12 months or even last 6 months of a equity bull market, there are quite nice, juicy gains that often do come through. The bigger issue that is at play, which we've touched upon a little bit already, is that there are some exogenous risks like the trade discussions escalating up to trade wars that might scupper the sort of nice economic growth and solid fundamentals that companies are providing us in the U.S. So I think it's positive gains should be expected, but with a pinch of salt.